Hello, this is Gary Sherman of Whaddadunce.com. Today, in part three of our series on bank valuation, we will be valuing the stock of Bank of America, which should be fun. To do that, we will be using the Whaddadunce software, the web software. And we've already, in our series on valuation basics, we have already went through the mathematics of the standard model. The mean reverting model is a little bit different, but we've already went through the mathematics of the standard model. So rather than regurgitate those equations again, we'll just use the software for our task at hand. The first thing that we have to do is we have to add Bank of America to our group. So you can see this web page. It's the first list box there is the public library. It's basically a library. We have 100 companies in there right now, and we'll just continue to add to it. But if you look at the yellow arrow, that's Bank of America, and what we want to do is we want to double click on that bank or Bank of America so that it becomes a part of our group library. And the group library is the list box to the right of that. And you can see we have 8 companies in there right now. So by selecting Bank of America from the group or from the public library, it'll add it to the group library so that we can now work on the valuation of Bank of America. Once we add Bank of America to our group, we can start creating scenarios. And this web page right here is for the group to maintain all of its scenarios. You can basically have an unlimited number. But in this case, you can see that we have 4 there. If you look to the right, under Bank of America scenarios, we're going to basically create 3. We're going to have the base case. That's going to use 2025 results. The adjusted base case is going to take those 2025 results and note that some of the parameters or some of the results for 2025 don't really reflect go forward reality. Whenever you create a valuation scenario, that scenario should have parameters that reflect more or less an average of the good times and the bad times. But to a great extent, 2025 was the good times. So therefore, we have to adjust the base case. And then we're going to have the third scenario, which is going to be our recession case. Banks do not perform well in recessions. I've made a lot of money on buying banks when the shit hits the fan, so to speak. And for this case, we're going to create a recession case. So we'll have 3 scenarios, and then we'll kind of make sense. We'll basically look at those 3 scenarios and kind of make sense of whether Bank of America is overvalued, undervalued, or fairly valued. So our first scenario for Bank of America is going to be the base case. And this is the scenario where we use 2025 results of operations, and we'll see where that leads us. In this web page, we're going to calculate the base case return on capital, return on equity, return on tangible capital. That all means the same thing. Now we've went through the math in the previous sections. We manually calculated all of these parameters, and we manually calculated the return on capital, which was 11.83% in the previous sections. And as I mentioned before, is the software does all these calculations for you. So everything that we've done from this point on, or from this point, or from the beginning to this point, we don't have to go through the torture of calculating all this data again, because it's all here for us. So let's work through this web page from starting at the left-hand side. Historical data. We have, I think for Bank of America, we have around 8 or 10 years of financial results for Bank of America. And in this case, we only need the latest five years. So if you look at the reporting period, we have the December 2025, December 2024, all the way to December 2021. And if we work down, we have the assets. That's asset composition, which we've already done manually. Capital, same thing. The capital ratios, same thing. If you look at the gray arrow there, that's our base capital ratio. And we can see that it's gone from a minimum of around 7.1% to 8.23%. So around the 8% threshold. That's pretty much what we have for our base capital ratio. Then rates, the section on rates, we've calculated these manually, at least for 2025. If you go to the yellow arrow or orange arrow, we have the efficiency ratio, and we can see that for Bank of America, the efficiency ratio has come down. It started at 67% approximately in 2021 and has decreased to around 62% in 2025. And also, if you look at the blue arrow, that's the income tax rate. We can see that the income tax rates were low, except for all of a sudden in 2025 it increased. A lot of that is due to a lot of tax credits that Bank of America was receiving, which reduced its tax burden. And all of that can be obtained from the notes to the financials, which we also have. For every financial statement, we have the notes that go along with it. So those are easily accessible. So if you go to the middle table, those are our model assumptions. These are the assumptions that we used when we calculated the return on capital manually. We started off at base assets of 3315, base capital ratio 778, and work all the way down to the income tax rate of 19.06. And the light bulb to the right of each one of those yellow boxes, you can click on the light bulb and it'll tell you exactly what, for example, if under net interest margin, if you click on that light bulb, it'll tell you what net interest margin means and basically how to use it. So it's kind of a guide for, you have these yellow boxes, all the parameters. The light bulb tells you exactly what those parameters are and how they're supposed to be used. Then if you go to the right again, we have the model results. As you can see, we have a return on assets of 0.92 and a return on capital of 11.83. And this is exactly what we've got when we work through the math manually. So it's no surprise that if we use the parameters that we use for the math that we did manually, if we plug those same parameters into this web page, then we'll get the same result, which we did. Also, there's a check, the green arrow. That's kind of a check. If you the actual net income, operating income for Bank of America is 3509. And when we plug in all our parameters, the implied net income is 3510. So it's basically the same thing. That just acts as a check to see, if your net income is going to be over or under what was actually reported for that year. Using our base case return calculation, we can now value Bank of America for our base case. You can see if you that black arrow points to the so Bank of America as of the end of June was trading for around $57 a share. So that's what we want to, whatever value we come up with, we want to compare it to the $57 to see, where we stand. The model assumptions or the historical data to the left-hand side is exactly the same as the as our base case return, and it'll be the same for, regardless of what we do, whether we calculate the various returns scenarios or valuation scenarios, all that historical data will be the same. Then the middle table is our model assumptions. We have base assets of 3315. We had our capital ratio 778 from the previous page. We're going to assume that our assets grow at around 4.5%. And then we're going to assume that the return on capital from the previous page was 1183, so we plug it in there. Our cost of capital is 8.8, which we determined already. The income tax rate 19.06. So then we click on the Run Model button, and we can get the valuation. So let's go through that. The revenue margin of 115, that is the discounted value of all the income of net income of Bank of America from today on, assuming, given the assumptions in the yellow box. The next one is 44. When we plugged in 778 for the capital to assets ratio, there was a little rounding problem or rounding issue. Capital excess deficiency. That basically what that says is if I have a capital ratio, let's say my capital ratio currently is 7.5, and I want to use 8. Well, I'm going to have to contribute capital to the company in order to bump my capital up from 7.5 to 8. So that's the cost of that capital. And in this case, that's 44. Our unrealized gains and losses of negative 10,526. If you remember from the previous sections, when Bank of America had securities that were underwater because rates increased, and they ran that loss, that 10,526, through the capital account. But what we want to do is we want to account for that separately. So that's basically a mark-to-market adjustment. Then we had the balance sheet investment. That is, if our assets are going to grow at 4.5%, our capital is going to have to grow at 4.5%, which means that some of the earnings are going to have to be plowed back into the company. And the 281,524 are those earnings that have to be plowed back, or the present value of those earnings are plowed back into the company. And then if you go down, we have preferred stock. We have to subtract that. And so if we add all that up, we have the value of common stock of 397,117. And then we have to divide that by the number of shares, which is 7680. And this is fully diluted shares. So we want to take into account that you have a lot of options out there that are in the money, and those are going to be exercised. So that would be the number of shares after all the in the money options are exercised. And that gives us a common share price of 51.71. So if we go to the table to the very right, we have the actual price, 56.98. And then our implied price, this is our valuation, 51.71. And based on this model, we have a overvaluation situation of about 9.25%, which is not bad. So the model using the current 2025 parameters comes up with a stock price that's pretty comparable to what B of A actually traded for. Our second scenario is the adjusted base case. Now, for the base case, we use 2025 parameters, which were the actual results of operations, which may not be indicative of the future. So therefore, we have to make some adjustments. This web page calculates the return on capital for our adjusted base case. So really, all we have to do is we have to take the base case that we have already looked at and just change a couple of numbers. So what we're going to do is the first thing we want to do is we want to look at that orange arrow. That's the efficiency ratio. The efficiency ratio that we used for the base case was the actual efficiency ratio for 2025 of 61.65%. And in the previous sections, we saw a time series of, for all the banks, of efficiency ratios that was published by the Fed. And the efficiency ratio for all of the banks averaged around 60%. So we're going to assume that the efficiency ratio is actually 60%, or we can get it down to something that should be good go forward. So we're just going to reduce the efficiency ratio a tad, which should add to value. The second thing we're going to do is we're going to look at the blue arrow. Those are credit losses. Also, if you looked, now for the base case, we use 48 basis points for credit losses. But if you looked at the time series for credit losses for banks published by the Fed, the average credit loss was around 85 basis points. So remember that whenever we do a scenario, we want to make sure that our parameters aren't just good time parameters, because we assume that those parameters carry on in perpetuity. So in this case, what we want to do is we want to bump up our credit losses from 48 basis points to 85 basis points. So again, we press the Run Model button, and we get a new return on capital of 11.05%. And remember that in our base case, the return on capital was 11.83, but because we increased the net charge-offs, and which was a negative, But we also decreased the efficiency ratio, which was a positive. The net result is that our return on capital went from 1183 down to 1105. And when we run our adjusted base case valuation, we're going to use that return on capital. On this page, we're going to run our adjusted base case valuation. If you really, all that is we took the base case valuation and changed one number. We changed the return on capital. Remember that the return on cap, if you look at the blue arrow, if you went to the base case, the return on capital was 1183. But for our adjusted base case return, it was decreased to 1105. So that's what we want to use here. So if we change the return on capital in our base case from 1183 to 1105 here and press the run model button, we have a different stock value. Everything is pretty much the same. If you look at the revenue margin, unrealized gains and losses, and work all the way through, our new common share price is 45.88. So therefore, what we want to do is we want to go to the very right-hand table, and we have the actual price of 56.98. We have the implied price from this valuation scenario of 45.88. So the difference now, as far as being overvalued, is around close to 20%, which is not bad, but now we're starting to get into the area where we might be concerned. For our final scenario, we're going to run the recession case. And for this, for the recession case, we're going to use a different model. All the models the model that we talked about before was a standard model where we have one set of parameters. But for this model, we're going to use a mean reverting model, which is really cool because it allows you to say that the parameters I have today are not going to be the parameters I have, 3 years from now. So it allows some parameters to change, and we're going to take advantage of that for this scenario. For the mean reverting model, we want to calculate a short-term return on capital and a long-term return on capital, with the idea being that the short-term rate will migrate to the long-term rate over time. So it gives us a lot of flexibility as far as, so we're not stuck with just one set of model parameters that we assume goes into perpetuity, but we can actually have model parameters that change over time. And that's what we're going to do here. So this is going to be our short-term return, which is going to be the return that we start with, or basically the return on capital now. It's basically the same as the base case return, but we just change one number. If we go to the blue arrow, what we're going to do is we're going to change the credit losses. Now what we're doing here is we're assuming that the bank goes into recession. So in recessions, banks do not do well. Their credit losses, pretty much go through the roof. And so what we want to do here is we want to assume that this is the recession case, which will eventually transition into a more stable case over time. So this is the recession case. So in the blue arrow, we're going to change our credit losses from 48 basis points up to 266 basis points. Now, we got that from the time series on credit losses for banks that the Fed publishes, and the maximum credit loss was, right around 2008, 2009 in the great financial crisis, where credit losses on average went up to 266 basis points. So that'll be our starting place. So if we take the base case model return and change the 48 basis points to 266 basis points and pressed run model, now our new return on capital is 3.73%. So given that my credit losses increased from 48 basis points to 266 in a recession scenario, our return on capital is going to decrease from 1183 in the base case to about 3.73% in the short-term recession case. In this slide, what we're going to do is we're going to calculate the long-term return for a recession case. So in the short-term recession case, we assume that a recession hits, the charge-offs for the bank increase, And then over time, things stabilize, and we get back to a scenario where, in the long run, whatever parameters we come up with are sustainable in the long run. So that's what we're going to do here. One thing we're going to do is look at the blue arrow. In the previous case, we assumed that the capital ratio was 778, but there is going to be a lot of pressure on banks to increase their capital ratios, and I don't think that Bank of America is going to be immune to that. So what we're going to do is we're going to say that our capital ratios are going to increase from 778 to 8.5%, at some point in time. Same thing with our efficiency ratio. In our short-term return case, the efficiency ratio is 61.65, and we're going to assume that that decreases to 60% over time. And the same thing with the charge-offs, or the gray arrow. We're going to assume that charge-offs go from the 266 for the short-term recession case to something more stable of 85 basis points, which we've used for the adjusted base case. So we'll assume that their net charge-offs decrease from 266 basis points to 85 basis points over time. So if we press the Run Model button, we're going to get a new return on capital of 10.12%. So now we want to run the mean reverting model for our recession case. So what we do is notice that what we're going to do is we're going to use the short-term return and the long-term return from the previous slides. Note the orange arrow. Those are our short-term assumptions. So this is pretty much where we are now. We're going to assume that our asset growth rate is 475, which is what Bank of America pretty much grew at in 2025. Our return on capital of 373, and that comes from the short-term return slide. And on our capital ratio of 778, which also, that's pretty much where Bank of America is right now. And what we're going to do is we're going to assume that all those, that the asset growth rate, the return on capital, and the capital ratio, it transitions to something that's more sustainable over time. And that's the blue arrow. These are our long-term rates. What we're basically saying is that the orange arrow rates will transition to the blue arrow rates over time. So our asset growth rate goes down to 3%. This is the 10-year Treasury is a good indicator of long-term GDP. But for stable companies who have been around a long time, their growth rate should be around 10 or 100 to 200 basis points less than that. So we'll assume that their long-term asset growth rate is about 3%. The return on capital goes up to 10.12%, and that comes from the previous slide, the long-term return. And we're going to assume that our capital ratios also increase from 778 to 850, which we took into account in the long-term return calculation. And notice the gray area, or the gray arrow. This is a transition half-life. What this says is that given that we have the orange arrow rates transition to the blue arrow rates over time, how long is that going to take? And the gray area says is that in 3 years, half of that transition is already done. So half of the transition between the orange arrow and the blue arrow rates occurs by the end of year 3. You can make that 2 years, you can make it 4 years, you can make it whatever you want. But in this case, we use 3 years. So we press, just like we did before, we press the Run Model button, and the green arrow gives us our new share price, which is $29.70. So you can see that the recession has really affected Bank of America's share price. So if we go to the very right table, we have our actual price at $56.98, our implied price, which is the common share price for this scenario, which is $29.70. So we're about 48% overvalued, which is very concerning because contrary to popular belief, recessions have not been outlawed, and there will be one coming. And this is our recession case, assuming that the recession hits right now. So now we're at the point where we have a decision to make. Do I buy Bank of America? Do I hold it, given that I already own it, or do I sell it? So what we're going to do is we're going to use those three scenarios that we ran. And remember that you can have three scenarios, you can have 20 scenarios. It really doesn't matter, but in this case, we ran three. So now we're going to base our decision on what do we do with Bank America based on those three scenarios. So now we have a decision to make. We can let's take a look at our scenario summaries. We have in that top table, those are our three scenarios. Then we have the actual price, we have the implied price is what we've modeled, and then the percent overvalued. And in all cases, overvalued, and especially in the recession case, it's the stock price isn't taken into account. A recession, if you believe one is coming right down the pike. So it would tend to suggest that Bank of America, even though it's not hugely overvalued, it's a stock that you should probably wait. If you can wait until right by all measures, the stock market today in the U.S. is extremely overvalued, more overvalued than it was in 1929 before the Great Depression. So any stock is going to be the tendency is going to be to be overvalued rather than undervalued, and that's what we see here for Bank of America. And especially if you look at the share price history, you can see that the share price is definitely volatile, but it's kind of taken off over the last couple of years. So if this was me and I had a decision to make as far as Bank of America, what I would basically do is I would hold off on buying Bank of America because the price is pretty rich, and you could probably get it for a lot cheaper once a recession hits. But the risk there is the recession will never hit, which I doubt is going to be true. But in general, I would, based on our scenarios we ran, I would hold off. I wouldn't short Bank of America, but then again, I wouldn't buy it either. I would just hold off and wait for the price to adjust, which might be coming in the near future. So come join our community at Whaddadunce.com. It should be fun.